Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of The Options Playbook. Today we have a treat for you in that recently NVIDIA announced earnings, and after their earnings report, the stock ran up once again. The stock was up over 100 points and is now trading north of $1,000. Because it's north of $1,000, in the conference call after the earnings announcement, NVIDIA also announced that they're going to do a 10-for-1 stock split, which obviously in most cases usually helps the stock. It doesn't do anything to the valuation of the company, but a lot of people like the fact that it'll be trading at a lower price and you can buy more shares of it. So with that said, I thought I'd take the opportunity to go back in time and talk about the deep in the money call position that we put on in NVIDIA last year in October 2023. So we started by being a little bit nervous in the marketplace. We were in October, and seasonality definitely played a little bit of part in that. So we bought one option contract deep in the money as a substitute for owning the stock outright. We then went out and added to the position. Now, one of the things that happened in NVIDIA is that the stock ran up and it quickly became a massive position relative to the other option contracts inside the portfolio. The entire portfolio was put together to be a substitute for a stock portfolio of option contracts. So, to be prudent in our account and to our strategy, we had to take the percentage of representation that NVIDIA had inside the portfolio and get it back to a normal range after the solid move up in the underlying stock. So in light of everything that has happened recently, I'm going to go and start by showing you inside the playbook the strategy that we're talking about. I am then going to pull up a PowerPoint and we're going to look at all the positions that we had in NVIDIA and how we adjusted the position to get the percentage of NVIDIA inside the portfolio back to the beginning percentage that we started with. All right, so let's run to the options playbook. And I want to highlight the section on the website that talks about buying leap options or longer term options as a substitute for owning the stock. So if you go, here's optionsplaybook.com. We're in the rookies corner. You can find that under the categories right here. And here's buying leaps calls as a substitute for the stock. We click on that. We learn a little more. If you scroll down, one of the things that I want to highlight here is that if you're buying deep in the money option contracts or you're buying a substitute for the stock, you want a delta of 80 or more, and they will be expensive. And when we say leaps, sometimes people get a little bit bothered by that term, but it's actually an acronym that was put together by the Chicago Board Option Exchange when they introduced longer term options. And that's really all they are. So as far as a leap is concerned, it stands for long-term equity anticipation security. And it's a leaps. And you got to say the S too, because it is an acronym. So a lot of people think that when you're writing about them that you're actually misspelling the word, and that's not the case. Very straightforward. So if you'd like to learn more just about the strategy in general, you can go and check out this section of the options playbook, buying leaps as a stock substitute. And you know, when you have high price underlyings and you're nervous about where they're going to next, which NVIDIA, it is a little nerve-wracking. And even at this point in time to say, you know, where do I think NVIDIA is going to go in the short term? In the long run, bullish, a little bit more a lot more bullish than would be bearish. And that's proven to be the case over the last couple of years. But with that said, you still get nervous every time it makes a big run up. And obviously, it's all about the AI hype, and they're the leader in the space. So let's bounce back out, and we're going to go and look at the PowerPoint then that we have all set up for NVIDIA. So let me move the playbook around, and we'll show you the position that we have inside the TradeHawk software before it's all said and done. So let me get into the presentation mode. And here you go. Okay, so in our PowerPoint, we have the title is NVIDIA Deep into Money Calls. So these are the initial purchases. We got the OG for the options guy, and here's optionsplaybook.com down at the bottom of the slide. So if I go in and think about October. So we're back in October. The markets were a little bit choppy in September and October of 2023, and then we hit November, and then haven't looked back since. So on 10/18 of 2023, NVIDIA was trading at 424.40. We came in and bought one call option contract, and we paid 155 for that. So $1,500 per call option that we bought. Now that's a lot less than buying 100 shares of stock. You're looking at about putting up about 30% of the underlying price. Now we're going all the way out to January of 2025. So that's 455 days to expiration. So this is a real option contract. Our delta was 78 at the time. That means that if the underlying stock went up 1, we would expect the option contract to go up about 78 cents in price. Now, that's all in theory. And the biggest thing about the NVIDIA option is that we still have a lot of time value. So if you're buying deep in the money option contracts, you still got to realize that it does act a lot like the stock, but it's still an option. It still has an expiration date. And especially going out this far in time, a lot of the price, it's mainly going to be intrinsic value, but it still has extrinsic value, or otherwise known as time value. So the market value of that option contract, if you take 1, multiply that by 100, times that by the current price that was quoted at that time, and that we actually filled inside the paper trade portfolio, and you get a market value of $15,500. All right, so that was October. Didn't want to jump in, and very rarely would, with any deep in the money call options. I'm not almost anything where I'm trying to build a position on a stock that's a high flyer like NVIDIA is. I'm going to do it in chunks, and you may miss out a little bit, but also you may save yourself and be able to dollar cost average if the underlying market goes down. Well, in this case, the market went up, because I think most people know the story of NVIDIA, and it went from 424, and now we're about 1 month later, and we see the stock at 461.72. The goal was to make it about 20% of the portfolio the entire time, and we had a $200,000 paper trade portfolio that we had put together. Now, if you're doing that, first of all, let me say, I'm not going to take the whole $200,000 and put it all in deep in the money call options, because that defeats the purpose. We're in this as an alternative to the stock because we do have limited and known downside risk. We have time premium. We have issues because we have an option contract that we have to manage. So we have to manage the position a lot more than just buy and hold, the old Warren Buffett strategy, right? And just buy it and come back 10 years from now and see where the underlying stock is at. We have an option contract. It's got some time premium in it, but it also reduces our risk on the downside. The maximum risk that we have on this portfolio is that $15,000, $15,505 to be exact. And that's it. That's the most that we can lose on that trade. Okay, so we come back, we buy 2 more. We notice that it's the same expiration. The delta is now 87. The time value has actually gone down. Why? Because we went deeper in the money. We did lose some days, but that was about, it looks like 54 days to expiration. But what really drove the time value in this scenario is the fact that we are almost a 90 delta at this point in time. So that means that the stock goes up 1, our option contract is going to move 87 cents in theory based off of this information. So now the market value of this position is 35,610. Add that to that, and we get a total market value of 51,115 on a 200K portfolio that I mentioned. That's what we started with. That's 25% of the portfolio. Now, it's good if it becomes more of the portfolio. That means that the underlying stock is going up, but you also got to stay grounded in all of your positions if you're truly trying to stay diversified inside your portfolio. And in the paper trading portfolio right now, we currently have some Eli Lilly, we have some Caterpillar, we have some Google. So we have some stocks that are, in many different industries that we bought deep in the money call options on, because we want to use diversification to try to help manage the risk of the portfolio. Okay, so we go to the next slide here. And now we have a real big run up, right? So now the stock on February 21st of 2024, so we're in 2024 now, the new year has happened. Nvidia was trading at 681.45. So they were about to announce earnings. It had a real big run up, even just from November till February 21st. There's now 331 days remaining to expiration. The delta is approaching 1, and that's always kind of a sign for me that we're getting way deep in the money. This is a good thing overall. It's just something that you got to manage. We're still in that same option. So we chose to take some money off the table. We went out and sold the close. That's what STC stands for. One NVIDIA option contract with that expiration, 320 strike call, and that was now trading for $380. That means that we reduced our position from 2 contracts down to 1 contract, and our market value not on this option contract was $38,000, and that we literally executed it for exactly $380 inside the paper account. Now we turn around, and in hindsight, well, it was kind of sad that we sold that option contract, because now we go another month out and we look at the position. And ideally, inside the paper trading portfolio, inside Options Guide TV, we're not looking at this every day. We're paying attention to what's going on in the marketplace. But as you notice, we're placing trades about once a month on the management of the positions. And in ideally, well, I guess the situation really is that we need to manage the position because it's moved so much. Now, NVIDIA has obviously done really well, but it's a learning experience because we needed to adjust the position instead of just ignoring it and getting way deep in the money and having all that risk. So we needed to take some risk off the table. You could say in hindsight that it was a wrong thing to do to sell this option contract, but that's what the strategy called for. We needed to bring the market value down of the option contracts. So we sold it. NVIDIA announced earnings. Stock actually went down, if I recall, and then bounced right back up. So then it came roaring back. And now we're 1 month later on 3/27/2024. And I don't want to lose any more of the option contracts. We're only down to 2. So I decided to roll the option contract. And the part of the thing about rolling the position, and I usually want to do this if I'm way deep in the money, is if the delta gets to 1. And you notice here the delta was 96. Now we're at 1. We were very close to 1 here. You could have said that we could have maybe rolled the other 2 option contracts to try to reduce the risk. So if you want to get nitpicky about it. But here now it makes 100% sense to me to roll this position and go back to the original strategy, get the portfolio back to a 20% allocation inside the entire portfolio. And we did that by going out further in time, because as I mentioned, longer term bullish on NVIDIA, short term nervous, scary. We're coming into the summer months. The old adage, which doesn't always play out 100%, right, is, sell in May and go away. And I'm a little nervous about where NVIDIA is going to go next if you're just a real short-term trader. So here's how we're going to manage that risk. So we come in and we got 2 of these option contracts. We sold 1, we got 2 left. We're selling to close 2 of that same strike option contract. It now went from 380 to 596.40. We went from 331 days down to 296 days. We're still just under a year, so we still got a lot of time premium. We're still dealing with slow rates of time decay. Got a lot of susceptibility to implied volatility, those little things in there. But in general, we're now down to 296 days. Delta's 99. That value of these 2 option contracts is $119,280. So we sold that. We brought that in. We then, in the same trade, bought to open to June 6, 2025 option contracts. So we went back to about the original days to expiration because I still want to be long NVIDIA longer term. And I'll probably end up rolling this out again if we continue with this paper trading portfolio and trying to use this feature of the TradeHawk software to learn about managing deep in the money options. We're now at 450 days to expiration, and the delta is now back to 80. We have 2 option contracts. We sold, we brought in this. Now our market value is $64,200. More importantly, in that situation, we have the entire portfolio value of 330K. So we started, now there's other options that are in this. This isn't all NVIDIA. Eli Lilly did very well. Caterpillar actually ran up and we sold it. Then we bought back in. Google has done very well inside of the portfolio. We also have Amazon in there. So just the market in general has done well. So the entire portfolio, it did very well. Now looking at that new position, we're back to 20% of the portfolio. So now it's not the dominant player where we have all this risk. We've used NVIDIA. We wrote our account up on the back of NVIDIA and we brought the position back. Like I said, in hindsight, gosh, I guess you would say, I wish I didn't sell that call. But you know what? That's what the strategy does for you. And if NVIDIA ends up dropping, 300 or 400 points, going into the 10-for-1 stock split, right? Some people might use that as an opportunity to sell off the stock before you get into the split. There's many, whenever you get something that has had this big of a run up, there's always danger because stocks in general don't just go up straight up for years and years and years and years. Very few and far between situations where that's happened. All right. So now we're comfortable with our portfolio. We've taken off some of the risk. We let NVIDIA do a lot of work for us. It's helped us grow a real good portfolio. Started with 200,000. We're now at 330K. And here's the numbers. So the purchases, these were the dates that they were purchased on. The 2 option contracts, 10/18/23, spent 15 grand, 12/11, spent 35 grand. A net debit to the account of 51,115. On the sales side of things, we went in and we sold 1 option contract on 2/21, brought in 38K. Then we did our roll, and part of the roll was done for a net credit to the account when we did the roll. But the sale part, the sell to close of the option contract, brought in 119,000. Total net credit, obviously rounding off here, is $150,000. And we still have a position on. We still have 2 option contracts on. That purchase and that market value at that point in time, which was important to us because we're looking at the percentage of the portfolio. You got to look at the market value relative to the total portfolio, and that was $64,000. So far on NVIDIA, if you look at the numbers and you just take this debit and this credit, you see that we brought in a credit off of the NVIDIA trade of $106,165. And that's just looking at the purchases and looking at the sales. And we're still not done. We still have a chip in a chair. So if we take this one step further and we go to the new position, we haven't got rid of NVIDIA. We still have risk. We could still lose that $64,200 in market value that we have in the account. But notice that I say we are long now. We're not buying to open, not selling to close. This is our actual position. So we refer to it as being long to NVIDIA. June 6th. Now, remember, we went out further in time, 450. When I put these slides together, 450 days to expiration, 700 strike call. Remember, we started with the 320 strike. And that was trading for 321, which is about what we paid for the initial option contract, if you go back and look at that. And 41,000 in profit. We put that away. So we took that money off the table, kept our position on, plus any additional proceeds from the sale of the next 2 remaining call options. So these slides were all put together, and all these trades were obviously done because you saw the dates before their most recent earnings announcement. All right, so let's sum this up. let's go look at the paper trading portfolio. So let's back out a little bit here and let's bring up the TradeHawk software once again. And this is the full-blown paper trading portfolio. And all I'm showing you here are the positions that are in the account. All right, so come on back and we'll take a look at it. And here's where NVIDIA is at right now. It's trading at $700 in the account, or the 700 strike call option. It was so the cost basis is $319.40. So that's the cost basis on the position. And the midpoint right now is $423.42. So since we put that on, that option contract has gone up over $100, 20,000, up about 32%. And now that's just on that position. Now, these are some of the other positions now inside the paper trading portfolio. I love the execution. The screens are all the same, but it doesn't do a good tracking. You're not seeing if you're selling some calls against the position. And to be fair, I want to let you know that we did sell some calls, but it's not tracking that as well as if you were in your regular account. If you have options that expire, it doesn't do as good as a job, but it does a very good job of showing you how to execute the trade and how to manage the positions. You just got to do the work on the back end, like I just did right now, to show you how the position panned out over time. So this is live. This is after the earnings report. We're seeing the other positions we have, like I mentioned, Amazon, Caterpillar, Google, Home Depot, the Russell 2000 Index, Eli Lilly. This position did really well. Also did the rolling on Eli Lilly because it really ran up. And then we got our one financial stock in here, Charles Schwab. And well, Schwab, I guess nowadays it's no longer Charles Schwab. I'm dating myself. That's it for this edition of Options Guy TV. All right. Click subscribe, ring the bell if you're watching it on YouTube. Check me out, InsideX.com, otherwise known as Twitter. And also go to the Tradier Hub and check out all the great speakers inside the hub, inside Tradier. And I love Tradier for sponsoring this event. And gosh, I hope to see you in the hub soon.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc. All rights reserved. Member FINRA SI.